Trish, how are you?
I'm good. Excited to be here today.
Yeah, and where's here? Come on, you just got to do this for the
I
audience.
am currently in a car outside of our CrossFit gym. Very glamorous settings.
I mean, come on, you're in the process of going through and prepping for a competition, so I'm not going to interrupt your goals and your ambitions. So, um, yeah, so this is called devotion right here, and I'm very appreciative that you're willing to do this even while you're in the practice and of your competition. So, for the listeners that are not familiar with you and your background, I was very intrigued because you guys have a completely different setup and of like how you guys are buying companies and what you're doing with them and where you guys came from. And I think I'm very excited to peel that apart for everybody. So, just from the top, kind of you can do the flyby, and then we'll unpack the
Yeah,
different parts.
sure. Sounds good. So I started a firm called Chenmark in 2015 with my husband, James, and my brother-in-law, Palmer. Which is like a bit of a weird group to start a company together. But it works for us. And at this point, we really wouldn't have it any other way. Um, and we all had sort of a background in traditional finance. And after we sort of had like maybe like a late 20s crisis about you go to, we were all pretty driven people. We went to like good schools and had good jobs. And at a certain point, we were like, okay, but is this what we're going to actually do for the rest of our lives? Like, is
Well,
this
and
it?
unpack that a little bit, true, Trish, because like
Yeah.
it was the traditional, like what a lot of people think about earning the buku bucks and the finance route. I mean, I think you
Yep.
guys, it's pretty important. Like, what was why did you guys have that 20 midlife 20s crisis?
Well, I think it happens to a lot of people. It happens to a lot of people that we're actually, recruit right now is that, I'll speak to my experience. I went into finance right out of college in New York City, kind of living almost like a Tom Wolfe novel in a way. And it worked incredibly hard, made good money and learned a ton. And, it was a really great experience for a couple of years, right out of college. Then I went to business school and then I went back into finance because it just was kind of like, I was just like almost like unaware that there was a larger world out there.
And what is finance? So when you say finance for the
Yeah.
listeners, what does that mean?
So a lot of different flavors of finance. So for myself, I was sort of randomly recruited out of college by a professor who was also a hedge fund manager. So I was an analyst at a macro hedge fund. And so the hedge fund was making, bets on interest rates and sovereign debt rates and, emerging markets and shipping rates and like really anything, if there was an interesting idea that was out there, like it would be like, go, find out what's going on with the Baltic Dry Index, which is like the shipping index. Like what's the drivers and like get, talk to people, come up with an opinion. Like that was my job essentially for a couple of years. And I mean, it was super interesting, incredible. James was a currency trader and Palmer was an equity research analyst. So we weren't
Quite
even
the
like,
team.
yeah. And we weren't even really like in the part of finance where we were like like we weren't in private equity, we were not investment bankers, we were in like a more of like the trading part of finance, which it is I think I've met in a lot of incredibly hardworking people in that space and a lot of just really really smart people go into that space because it's a very intellectually challenging space.
Hmm.
And so like it was an incredible life experience. And I went back to business school just to kind of round out my education a little bit because the fund I worked at was relatively small in terms of number of people. So I never really had like any like quote unquote like corporate training or management training or like
Hmm.
any of that sort of stuff. And I was always kind of like interested in like the business side of things, not like not just the trading, like investment side of
How
things.
do people actually run a business that makes money, right?
Yeah, yeah. And so I thought that was interesting. So I just kind of wanted to like broaden my horizons a little bit. Seemed like a good kind of time to make a change. And then I went back into finance to a different type of firm. It was like quantitative asset management fund called AQR. And I learned a ton there as well, but still in the more finance side of things. And it was about like 1 year after business school where we were living in like the New York suburbs and we bought a house and then I kind of looked around. I was like, I don't want to do this for like the next 20 or 30 years. Like this is not like what I want to do. And I had the privilege of interacting with a lot of very successful people who had started their own investment funds. And I like always thought like I want to be those people. Like I don't want to be like the junior person reporting them. Like I want to be that guy. And I think there's also a layer of like when you actually get to know some really successful people, you're like, oh well, this person isn't like, you know,
They're not a
that.
god.
Yeah, right.
Yeah.
Like they're like a normal person, just like everyone else, and they make mistakes, and they've got, you know, some incredible gifts, and they also have, you know, flaws, and they become real to you. And to me, that was actually quite motivational because I was like, well, you know, I could probably do some of what they did. And the one thing I will, just flipping forward, the first thing I realized as soon as we actually became business owners is that being a boss is a lot harder than it looks. Like
It's not just
it,
all like rainbows and unicorns, and that's just top of mind because of my
yeah,
kids.
you know, like being it like the number two is like very easy, or like a junior person, because you're like, oh well, like it's very easy to like criticize the decision someone's making, or like think that like they're not paying attention or they're disengaged or whatever. And then when you're actually in the seat, you're like, oh well, that person was dealing with like 100 other things I was unaware of. And like whatever I thought the decision was, like it was probably competing against some other thing, and they were choosing between two difficult, you know, roads, and I only saw like a very small sliver of what was going on, and I also was never the person to actually make the decision, and that's a lot harder to do.
Mhm.
So I now have a lot more respect for my old bosses because I realized like they were actually doing like the best job that they could. So anyways, we started kind of being like, you know, and we were all basically having the same situation, you know, same experience. Like, is this really what like we're gonna do? And all of us were like, it just didn't sit well. And so we started looking around at the time just for kind of like side hustles, like kind of like interesting investment theses that were kind of
Mhm.
like, you know, a little different. And we had there was one like random newsletter that we'd read that talked about how like car washes and laundromats and like those sorts of just like boring businesses would be like that they had steady cash flow, would be really good in a low interest rate environment. And so that was always something that was like, okay, maybe we could buy like a car wash or a laundromat or like one of those types of businesses. And then Palmer had actually left his job and was working at this sort of smaller education company. And he had thought, okay, well, we sort of had like conversations about, you know, oh, well, maybe like, you know, if the owner wanted to leave, like you could buy that company out or something like that. And it kind of was, I talk to a lot of people who like will call me up and be like, here is my grand strategy plan for how I'm going to create this like holding company of small businesses. And I'm like, that sounds cool. That was not our experience, really. We basically were like, you know, it took us like a year of kind of like tossing around the idea and having it evolve naturally. And it was sort of a like, okay, well, like let's Google like how do you buy a business? And then like things came up, and then like we found some small business brokers, just start calling them and being like, I don't know, tell me about this business. And like we learned everything kind of like incrementally. And the more we learned about the sort of small business ownership space, the more excited we got about it, and like the more confidence we had to be like, hey, this is actually something we want to do. So I remember very clearly September of 2014, I remember because we were talking to James's parents, and we were like, this is what we want to do. We want to buy, there's a ton of businesses out there that have retiring owners that just are basic, boring businesses that are going to be around, like the kind of backbone of the economy type businesses, and they have steady cash flow. We can buy them, you know, I think at fair valuations, nothing crazy. We can be long-term owners, and we want to build a portfolio of these cash flowing businesses, and we want to use the cash flows that we generate from one business to buy the next business. And that was essentially our like idea after like kind of a while of toying around with it.
Didn't you say you went back to in our conversation? You said you went back to your business school that you didn't, because now in some of the schools they're
Yeah.
actually teaching acquisition through entrepreneur through
Yes.
acquisition and stuff. But you didn't even take any of those classes, right? You went back and started like asking some questions or something.
Yeah. No, I was like I kind of definitely wasted some opportunities in business school, because when I was in business school, I was very focused on going back into finance primarily so that I could have a firm pay for my business school debt. So like,
Mm-hmm. Pretty
that
good
was
thesis.
like what I want. Like that was my goal. And like, you know, the nice thing about finance is like those firms have a lot of money and like they'll pay for your business school debt. And so like that's great. And so I was very, very focused on that. And I also like I liked intellectually, I liked my job. Like I thought it was very interesting and I enjoyed it. And so when I was in business school, I took other than like the one forced operations class, I didn't take any operations classes. There was, search fund or entrepreneurship through acquisition classes. I didn't take any of those. So, when I talk to people in business school now who are in those classes or who are talking to me, I'm like, you're ahead of the game. Like I was,
What I what I what
I
I
wasn't
think
even
about that.
thinking about that.
But what I think about it, Trish, though, is that like when you talk about how it took you a year and you were noodling around on this, and when in our previous conversation, you talk about how like it was just forming this opinion, then and maybe you were getting to this, but you had this use case of like, oh, now there's a practical thing in front of us. I think that your approach makes way more sense sometimes. Like when you said that people come up with these grand plans, the example you gave, you know how many times I have people that'll reach out because of the podcast, and be like, I have this grand plan, $1 billion, holding company. I'm like, how have you started? Well, with
Right.
more thoughts and ideas. So it's like, well, how are you going to execute that? So I don't know. Take it for what it is, but I think your approach is probably more practical, and what you've been doing is, I think, proof that it's working.
Yeah. I mean, it's I think it's for us like every step along the way. It's just been like our attitude is sort of like take action, test something out. If it doesn't work, pivot, move. Like and very kind of like quick iteration.
Mhm.
So we've never really been like grand strategy type people. And frankly, like once we figured out like pretty basic big picture, like we want to own businesses for the long term that generate cash flow and have a portfolio of those things. Like once you figure out that thesis, like I don't need to spend any time thinking about it. Like it just is there, and like that's
There you
it.
go. End of story.
Yeah, yeah.
So
So
where were you guys when you like all of a sudden it started becoming real because of the choice in front of you?
yeah, so we said like, hey, this is what we're gonna do in September of 2014, but we are also working. And then we started and there were three of us, so that's very important to emphasize. And we started basically reaching out to brokers to talk about businesses for sale. And based from the Palmer happened to be living with us, like we were all living together at the time. So get home from work, talk about some listings, stuff like that. We did visits to companies on the weekends, and covert calls in corporate meeting rooms, pretending they're real work when they weren't. So sorry, old bosses, if you're listening to this. Uh, and when we had a deal, which was the first company we bought, which is a property like a landscape maintenance and snow removal company up in Maine. As that became more real, well, we all kind of slowly rolled off of our jobs. I was the last one to leave. And when that opportunity became like, okay, this is real. And even if this falls apart, this is still something we're going to do. So like that was when we were like 100% committed. And I also felt like I liked the people I worked with. And like I felt like I was lying to them because they'd be like,
Mhm.
oh, like, how was your weekend? And I'd be like, man, like it was fine. But like in reality, like I'd rushed out of work on Friday, like got like taken a flight to, I don't know, Kentucky, met with an owner all day on, Saturday, and then like come home on Sunday. But I couldn't tell them any of that. So I just would be like pretend I
Meh.
did literally nothing like every weekend. And so when I felt like I was lying, I was like, this just isn't sitting well. And you know what? They were all very, very supportive, and it was really nice. And so we sold our house in Connecticut. We moved up to Maine, actually before the deal closed, which was a little bit of a risk, but we were like, well, this is what we're doing and we're committed to it. And if this doesn't work out, then we'll figure out the next thing. So we took
Well,
definitely a risk there.
and you bunked up with some family from what I remember.
Yes. So we ended up moving in with the in-laws. Yeah.
I was
So
gonna say I have to
was the
say that.
interim. That was the interim period. That was a little awkward.
Well,
Yeah.
I think it's important. I think it's important for everybody to note because it's like you went to business school, you're in high finance, and then you still have to take a couple steps back to leap forward. And it's just so important. And so like as you guys are thinking about this first business, Trish, and maybe wherever you want to take this as far as, because I think going into like your guys' approach and what you've been doing, but then also how did you set it up and what was your guys' plan to set it up from the beginning, and why did you choose the structure and approach that you did?
Well, I'll tell you first thing, when we set it up, we didn't have an approach or much thought around it. Our first deal was just like talk to a lawyer, set up an LLC, and like that was it, you know? And so
Just use an
basically
SBA loan or something?
we did not actually. Our first deal was the sellers initially ruled some equity and they provided seller financing. So we didn't have any external debt
Nice.
in our first deal, which was very, very helpful. And it also was, it just made things easier for us, especially since like, I don't know, we were kind of like a weird group of people asking for a loan, and I'm not actually even American, I'm Canadian. So there's that added complication with the SBA, like things like that.
Yeah.
So that made things easier. And so it wasn't until I forget, we had a couple of deals, and we always had this vision of sort of a holding company, and it's kind of almost hard to articulate, but a
You
holding company.
you can,
Oh yeah,
I was gonna say, why don't you just start from the top of how it's structured right now, and then we can go back,
yeah.
because I think it would be interesting, and bring me back there if I forget, but how you guys started your first few Ds, because I think even people that own companies right now or people that are looking, how to even get started, what size company, the different kind of choices that they have that they don't know how to navigate through. But why don't you start from where you're at now and then how you kind of landed on that?
Yeah, so where we're at now is we have Chenmark Holdings, which is a C-corp, and it owns 100% of all of our subsidiaries, which are LLCs. And the reason that we set it up that way is because we care, like our highest priority is long-term compounding of capital. And so we wanted a structure where any profit, that capital essentially stays in the company, and that we had the flexibility to transfer cash from one entity to another or back up and to the holding company. Because our whole model is, let's say we have one company, I'll just make up numbers, so let's say
Yep.
we have a company that made $1.5 million of profit at the end of the day, and they really only need $500,000 of it for like the needs, growth in the company, working
Mm-hmm.
capital needs, whatever. So they have an extra $1 million. Now, if we were just like a normal, like single proprietor, person, we just distribute the $1 million to ourselves and like buy a boat and like do whatever it is people do with $1 million, but they distribute it to
So
themselves.
wait, that's not compounding interest when you take out the money and buy a boat?
That is not. But for us, what we want is that $1 million to come back up to our holding company, and then we use that $1 million to buy a different company, or to maybe invest
Mm-hmm.
in a growth opportunity in a different company or something like that. Because a lot of the companies that we buy, they might not have use for $1 million of growth or investment opportunity internally, and there are a lot of businesses out there like that. Nothing wrong with that. We just have created a structure where we have another, like a better use for that capital.
Mm-hmm. Mm-hmm.
And so we're focused on taking out as little as possible, because in a C corp, you're double taxed. You're taxed on like the profits of the business, and then you're taxed for like personally as well. So like
Mm-hmm.
most investors who are interested in yield or like, want to make sure they're like getting capital out as much as possible, would be very strongly against the C corp, because for those people, it's not tax efficient. For us, because we are looking to deploy that capital and other investments under the Chenmark umbrella, it is very tax efficient. And so and it also allows us to have, you can do this in other ways, but common ownership across everything.
Mm-hmm.
We can have shares that employees can buy. There's also like a weird tax code of Section 1202, which provides some tax benefits if you were to ever sell your shares on capital gains and stuff like that. So there's some tax benefits that are specific to what we do. Not that I'm giving tax advice to
I
anybody.
know. Hey, this is the people have been listening long enough where I get myself into the legal and the tax world with full disclosures that I'm not any of those.
Exactly.
But
Exactly.
Trish,
So that,
specifically on the structure, like, and like maybe because I think it's so interesting what you're doing is how are you using what you just described for the C-corp and the shares and how that capital flows back and forth when you're buying the businesses and how that kind of allows you flexibility with like different equity chunks for different sellers that are selling. And so how do you use the mechanisms you just described to get deals done and to get everybody aligned?
yeah, so we're buying businesses from owners who want to retire. So they want cash. They don't want equity in our business or anything like that. So they want cash. And so what we're doing is, let's say you owe, Ryan's plumbing supply company and we want to buy your business, and we'll essentially, let's say it's a $4 million purchase price. We'll use 2 million of our equity. We'll get $2 million of debt. We'll pay you out $4 million. And then it's basically you sail off into the sunset. The equity stuff matters a bit more for the people we're recruiting to work at our company, because they have the opportunity to use their bonuses to buy equity in our business. So we feel strongly that over time, we really want, broad-based ownership of all of our top employees in Chenmark Holdings stock. And so this structure allows us to do that.
Awesome. And I want to that's super helpful, Trish. And I think to contrast that against like your everything you just described for the listeners, contrasting that against a normal private equity firm where they go raise the funds from investors that have a specific yield that they need with a date that they want the money back with. And then there's this entire, steamroll ahead of like, hey, buy companies, sell them to liquidate to get back. You guys have no obligation to do that because of the setup you just described.
Correct.
Which
So yeah,
it's super important.
we have no end date. We're not a fund. We don't have external investors. We have no need to sell. So the way we're set up allows for long-term ownership. We could own all of our companies for the next 100 years, and hopefully we do. That would be awesome. But there's no end date, and there's also no external, board or, investment sort of mandate or something that's telling us either like you have to invest in this type of company or you have to sell that company or whatever. James Palmer and I are the quote unquote investment committee. We're also the like HR committee and the audit committee and the recruiting committee. We're like, but we have autonomy. So, for us, that's important because I think we have a pretty clear vision of what we're trying to build. And I think that most sort of traditional investors probably don't share that vision, and so they wouldn't be like good partners for us.
And for the listeners, I'll put links in. So Sonny Vanderbeck and Brent Beshore, and there's some other people, Permanent Equity and Satori. They're more in the traditional private equity kind of setup, but there's some other people that are kind of doing what you're doing, which I think is so fascinating. It's kind of ties into this conscious capitalism theme that I'm always preaching about. And what I want to go like. I want to hear, well, first a couple questions. Like how many companies do you guys currently own now?
So we currently own 9 companies with name brands and CEOs, and we've done over 30 acquisitions because some of those are companies that acquire other companies.
Got it. And so, I mean, just for the listeners that had let that sink in since 2015, I mean, like you guys have been doing that much, which obviously there's success in the strategies that you guys are deploying. Now I want to go to Trish, like if you're talking to an owner and like we talk a lot about in the intentional growth principles, there's principle 3, which is the exit options. And there's, we talk about private equity, which is number 4. And we got a bunch of material that we unpack that, but then we explain how so many different flavors of that, like the family offices, your setup versus the traditional setup. So if an owner is sitting there going, who am I going to sell to because I'm legacy driven or I've got different needs and wants, like what are the personal desires and the things where it's a good fit for you guys and where is it not a good fit for you guys?
Yeah, so this is super important because I think a lot of business owners, they're going to be the most successful in their sale if they first define what success looks like to them. And
Amen.
yeah, which I'm sure you know. And, if it's all about getting out as quickly as possible with the top dollar, you know, honestly, we're probably not the right fit. And we say that up front.
Mhm.
If you're in that situation, you're probably best off selling to a competitor who will probably pay a big multiple, probably get rid of your name brand, probably get rid of a bunch of your staff, and will probably be able to close very, very quickly. And,
Mhm.
there is nothing wrong with that option. That's just, if you're thinking about your hierarchy of needs and those things are the highest, there's a certain type of buyer out there that would be a good fit for you. We have worked the best with owners who could sell to a competitor, but don't want to, because they care about their business. They, in a way that, I'm not saying that other people don't care about their business, but the
In a
people who
different
work
way.
well with us, they really, it's important to them that their employees have a long-term home. For some of them, it's important the name brand stays because they feel a lot of pride in the name brand, and that the company continues to play like the same role in the community that it has played in the past. And so, and that they're with people that they feel like will take care of their company for the long term, who aren't just going to like sell it again in a couple of years, or are going to operate it well, and they want to see their company continue as a going concern and grow and all that sort of stuff. And that's where we, I think, are the right fit, because that's what we're looking to do. And
Let
we
me.
talk about just
Oh,
like
good.
preserving legacies is kind of how we talk about it. We're
Mhm.
trying to have things carry on the work that the owner
Mhm.
started.
What I think is so interesting, Trish, because when people go through our training, they talk about their first principle drivers, like what they want, all the things you talked about. Then there's the second principle, the financial targets. And then it's like these exit options and how to match all these things together. What's a fascinating combination that you guys offer is all the money up front, or whatever. Well, maybe there's some seller financing or whatever it is, but there's a liquidation event where people are retiring. Like that was your purpose, right? Where so many of these other things, they get to this point where it's like, hey, I want my legacy, I want my community, I care about all these things, but I also don't want to stick around for a lot longer. And so it's like you're
Right.
having this kind of combination that it's not necessarily always the availability, because you can get all your money up front to it with a competitor, but you just mentioned all the downside. So like you could do an ESOP, but then you got to stick around or have a management team. And so like there's all these different things where you kind of provide. That's why I said that it's very interesting. I was interested to have you on the show because you've threaded the needle in a different fashion that can accomplish different goals that people normally wouldn't be able to. So like how are you finding these conversations? Where are people, how do these, maybe a podcast would be probably some of my guesses, but like, where do these conversations start? Like, how do you find people?
Yeah. It's interesting. So we do podcasts, but that ends up being more of a channel for people who want to work with us to be in our like leadership development program, people who are
Hmm.
interested in running a small business themselves. So that's really what podcasts have done for us. We haven't really seen that as really a way to connect. We always say that a lot of small business owners are like too busy to like listen to podcasts regularly.
I hope
Maybe
not.
they listen to yours, but not the ones that we've been on. And they probably listen to yours because yours is very targeted.
I'm not
Uh,
ripping off tax codes here for the
yeah,
most part.
exactly. But at first it was brokers, which we still do maintain relationships with business brokers. Some of them, are not high value add, and some of them are great. And I think that now they know, the ones that we have connected with kind of know who we are, and will often kind of call us when they have a company that's like about to come to market, which can be very helpful. We do some sort of cold outreach, but very personalized and targeted. We don't like mass spam people or anything like that. It's more with people who are in an industry that we're in, that we just kind of want to connect with anyways, and also just make sure they're like aware of us as an option if they
Hmm.
and when they want to sell. So that's the second category. And the third is that, just inbound and and industry relationships. So, you'll go to, I don't know, like an industry day because you're in that, like landscaping. You go to an industry day, the other owners, they know you,
Mm-hmm.
their employees know each other, and then one of them reaches out and talks to you at some point. So
Mm-hmm.
we have found that, especially since we're like trying to be very long term focused, we're more about like making a relationship with somebody and connecting with them and staying in touch and just being like, hey, like, you might want to sell 10 years from now, but I hope that when you do want to sell, you'll think about calling us and that you would like
Mm-hmm.
consider us to at least be part of the conversation. And, we haven't been around for, that long, but we've already found that approach, we might get a call out of the blue from somebody we talked to 3 years ago.
Mm-hmm.
That's just been kind of following us, because it's like like it's when somebody decides it's the right time to sell, it's like a highly personalized decision.
Mm-hmm.
And you could catch somebody when they're interested and maybe not.
Mm-hmm.
And for us, it's just making sure people know that we are one of many options
Mm-hmm.
if and when they want to go down that path.
That's awesome. So I want to go back to like your and your partner's thoughts about what good deals look like and then how you're structuring that snowball. And so I'm trying to think of how to the best ask this is and even I'm going to take a step back, why this is applicable to someone that wants to buy a business. Maybe someone wants to get into like, doing what you're doing to some degree. Cause I think more people around our age that are doing this, it's a different option for people that are retiring. Cause there's not enough buyers out there. I mean, that's going to be a problem somewhere down the road. But, my, I think it's also relevant, Trish, for people that own companies that are in their 50s or what shit, I don't even care, 30s, 40s, 50s, or 60s, where it's like you sell your business right now and all of a sudden you got $5-10 million or whatever it is. Where are you going to put that money? So like there's a strong investment thesis to say, instead of selling your asset, build up the infrastructure and then do what you're doing and have your current company be your platform company. So with all that kind of context, like I'm gonna curious, how did you start the snowball? I've got this picture of like when I've heard of other people where you're taking one snowflake at a time and you're trying to mash it together, and it's gonna take an eons to get that. But you guys have made some serious success over the last 5-6 years. So like, what does a good deal look like from like the cash flow and like the type of operations to keep the
Yeah.
snowball going?
So I'd say, I mean, first of all, as you know, it's an art, not a science. And, just kind of basics, we look for companies with at least $1 million of EBITDA, like 1 to 3 million of EBITDA. That can mean a lot of different things in terms of revenue, but I'd say anywhere from 2 to, I don't know, 15 to 20 of revenue.
Yeah, right.
So something that we would look at. And so
how did you get the first person to take that much of a seller's note and roll equity? Because like I think that's where like how do you get started?
No,
I don't even know. I love it.
It was, like I had a lot of conversations and
Trust, I'm assuming.
Trust, and they also wanted to sell, and it just kind of worked out. I've heard of people who have done deals with like 90% seller notes, like crazy. Like I've floated it a couple times and have run into a wall.
Rightfully so, in my opinion, but like,
Yeah. I don't know. We just, it's what worked. So then we look for businesses that have, so it's like very hot to talk about like, recurring, contracted revenue. Like, yeah, that's nice. And everybody wants like the perfect business.
Of course, right?
We look for things that what we call like reoccurring revenue. So it's more like, can we get comfortable with the durability of demand? So like an example of that would be like a tourism business that is, doesn't have contracted revenue, but is in a location where like for the past 100 years, people have come to that location because like whatever, it's on the water and it gets hot and people go there. And this provides a service to those people.
So
and
logical.
Like it's very, very consistent. And
Mhm.
so, no, it's not contracted, but we can get comfortable with that. Like the food manufacturing business we have, it's not contracted, but they serve grocery stores, and it's very, very predictable. Grocery stores place POs for makes bread products every single week, and we know who the competitors are, and we know what they can do and what we can do, and it just is what it is.
And people eat lots of bread.
And people eat lots of bread, exactly.
Well, and that, so on that question there, Trish, is like when you've said boring businesses and cash flowing businesses, maybe expand on that a little bit more, because you just kind of touched on
Yeah,
quite a few different industries.
yeah. So to us, it's like the sort of I feel like the sort of business where if you went to like a cocktail party, people would be like not that interested in talking to you if you told them like what business you ran. I feel like that's like a good litmus test to the types of businesses we would be interested in.
Oh, it's not the
If
case, man.
that, yeah, so it's like,
I gotta tell you just a hilarious story, Trish. So one of my best friends, he bought his family business, rental business, and a porty potty business and tent business. So he was
okay,
a
yeah,
managing, or he was his partner. I don't even know what the hell his title was. He was about a big CPA firm. So now he's wearing Carhartt boots and all this stuff. And he's got all these porter potties. We're golfing years ago, and we were driving the golf cart past one of his porter potties. He says, "Smell that?" You know what he says next,
yeah,
right? Smells like money.
like
And like,
money,
yeah, he's
exactly.
like, I'm the porter potty guy. And like, oh my
Yeah,
God, it's a very good business,
it's
but
probably amazing.
no one's excited to talk about it.
Exactly. We can get like a pretty good sense because, like, with people like I don't know, be like, oh, like, another example would be like, oh, like the drop off. Like, I've got little kids, so like the mom drop off, and it's like, oh, what do you do? And I was like, I don't know, I work at a landscaping company, and they're like super disinterested in talking to me after that. So like, to us, it's just like you could call them boring, but you just like normal businesses like that you see every day that are just like part of the economy that are easy to like forget that they're there. So like obviously landscaping, snow removal, food manufacturing, some tourism businesses we think are interesting, but it's businesses like I don't even know exist yet, right? Because
Isn't
they're
that
just
awesome?
so like hidden in the economy. So like, HVAC businesses, plumbing,
Lawn care. I mean, you just,
lawn
you name it.
care, elevator services, conveyor services, like all these sorts of random things we've looked at, can all be interesting. And I think what's also, we are not like operational experts. And like we're like we have no business owning like a I don't know, an aerospace manufacturing company, right? Like that requires like some highly specialized skill to run that sort of business. For the businesses we look at, you clearly need to have a team that has like a core competency in like whatever like that business is doing. But I think that in those areas, the businesses that do well have like people who are very, very good general managers
Hmm.
who kind of understand like the basics of marketing, the basics of finance, like how do you collect money, how do you bill, how do you like
Pay your
the
bills,
bill
collect your
collection
bills.
of things, how do you make sure customers get called back within 24 hours, like how do you have an online presence, like all these things that are not, we're not Google, we're not some fancy tech firm, like, but all of those basic building blocks require just sort of like a general management 101 skill set. And those are the types of businesses that work well, like the best for us, and where we think we can would be the best kind of owners for those types of businesses. So
I love it. I
if,
love it,
if,
Trish.
if it sounds a little vague or like
No, it's
open
not
ended,
like,
it's because it is. It's because it is.
well, let's make it a little less vague, because like I want you to comment on my comment, because I don't know if there's going to be a question here, so
Yeah.
bear with me. So is like when I think about like the exposure that I have, Trish, in these different markets, and I see a lot of numbers and a lot of cash flow, and it's like all of this bullshit hype about people raising money and then burning through cash with no intentions of ever making money on some idea that is kind of okay. And I'm just like, we just praise this shit, and like there's a spot for it, but it's not 100% of the marketplace, right? So like I get so frustrated with it's disproportionately showing in like all the tech stuff, which is great. I have no issue with it whatsoever, but it's like the rest of the world needs cash flow to pay their mortgage, to like, buy stuff. I mean, it's just like, and it's the things that actually make money. So it's like there's this realization I've noticed that like these, the investment companies, private equity, and whatever people that are institutional investors are going, shit, we can't keep doing moonshots. We need cash flow. So like I think that there's a sexiness in the cash flow that is starting to creep up, that is now less like, it's less of these boring business. I don't know if you're seeing
Yeah.
similar things or
Well, first of all, I mean, I agree. Like, obviously, there is space for investing in ideas that have not yet
Mhm.
been proven, but that
Absolutely.
doesn't mean that every startup who has a big idea is a good investment. You know,
Well
and
said.
like and we I don't we kind of think about ourselves as basically like the opposite of venture capital. Like we pay modest valuations for companies that have steady cash flow and probably are not going to grow a lot. Like they're going to grow a little bit, but they're not high growth companies, and that's like a real market, and frankly is like a really important part of the economy that I think,
Mhm.
because it's not, nobody wants to like read like the New York Times article about like, you know, mid-sized
Septic pumpers.
mid-sized mid-sized snow removal company grows 3% year on year. Like that's like not that interesting, right? And I do think that there is more like interest in cash flow. I still don't think it's anywhere like, you know, I still think that there will probably be like a reckoning with a lot of these
Mhm.
venture capital investments where people will realize like a lot of the assumptions they made about sort of future profitability don't pan out. I think some people like probably lose a lot of money, and I think when that kind of like plays out a little bit, there will be maybe like a more of like a
You
shift
think so?
back
Well,
towards like
and you think so? I mean, like I was actually just having this conversation with my dad, and it's like Planet Fitness is a $7.5 billion valuation. They're doing a few hundred million in revenue, and their debt to equity ratio is negative 250. I'm like,
wow.
what the hell? Like you go in there and you lift, you move around some iron. It's not a code, or it's just
Yeah.
there's not a lot of places making money. Swing back to I digress. I'll swing back to your strategy, and I'm
I
curious
will
on like,
just say, I'll just interrupt you though. If anybody
yeah, yeah.
listening to wants to value Chenmark like that and give us like an all cash offer, like you should call me.
Yeah, yeah, like, wait. Oh, no, 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 I'm sorry, church, we don't value cash flow. We just want really, really
Yeah.
cool ideas and logos that
Okay.
are shit, yeah, no.
Yeah.
Exactly. It's so absurd. It's so ridiculous. Hey, I wanna hear more about your snowball philosophy, because you mentioned it a little bit, and I think
Yeah.
a lot of people don't have the visibility in their financials. And plug here, they should go take our intentional growth financial assessment so they can see this. But the ability to how do you assess how much cash you can then pull up to the holding company and how that compounds? Like, so like when you're looking at your portfolio companies, how do you see the visibility into like working capital on each of these, and then what's going to be available to continue down the road?
Yeah, so there's like the actual working capital needs of the business, which are, you can kind of feel out, at any given time, and kind of look at your AR and your AP and kind of be able to match that up and know kind of what the amount of like what we call like quote unquote like dead capital that's just like in the business at any given time. Because
Mhm.
if it's not there, then like if one payment doesn't come in right on time, you're gonna like not have the funds to cover payroll or
Yep.
whatever. And so that, like anybody who's been operating their business for a while is going to kind of know that number. Then there's like and some of our businesses I think are pretty good at knowing like exactly what that number is. Let's say it's $200,000 and they have
Mhm.
$1 million of cash in the bank. They're like, I'll send them back $800,000, and like I know that like at my lowest point, like I might be down to like 10 grand in the bank account, but like I'm fine with that. Like they know it like
Yep.
very very
Mhm.
well. I would say other companies have like working capital that's at a certain level, and then they have like another layer of what I'd call like emotional capital
Yep.
that is like there just to make them feel safe, just in case something happens, and like they don't really need it, but like they like it and they like seeing it in the bank account, and like
Mm.
what, like
I
there's
get
nothing
it.
wrong with that. Like you
Right.
gotta sleep at night, and like so you just want to make sure that number's not so big that it's you know
Mhm.
so let's say we have $1 million of cash in the bank. $200,000 you actually need for working capital. You need $300,000 for your emotional capital needs. So then you send $500,000 back.
Mm-hmm.
And for us, our job as the like owners is to make sure that we have places to put that capital. And so we have, we're, all of our companies are always looking at their own growth opportunities, their own potential tuck-in acquisitions, and then new platform acquisitions. And so it doesn't really work if you don't have somebody in your organization that's thinking about, okay, well, now we have this extra capital. What is a good investment for this? I think a
Mm-hmm.
lot of small business or like individual small business owners kind of do this intuitively when they end up investing in commercial real estate.
Ah,
They use the
bingo.
money
Yep.
from their company to buy their real estate of their business or, rental units or whatever. And I think they're kind of in a way using the same thought process that we're using.
But you're more
Just
you're just you're multiple steps above that, and you just hit on just a huge point, Trish, that I want to highlight, because the like when people buy their building, it literally hits them in front of the face once a month. Like, oh, another $20,000
yeah,
rent payment. Oh, another $25,000 rent payment. Maybe I should own the building. And so then it's like, do I have
yeah.
enough cash? And so they so many people stumble into that. And the amount of times I see people where their building is actually worth way more than the business at the end.
I
Like
know it's
significant.
unfortunate when we see that. Well,
Yeah,
it's
I'm
good
sure.
for the owner, but it's also like, listen, man, like your business makes. There was like one business in downtown Vancouver, which is where I'm from. We didn't look at buying it, but it was like a breakfast restaurant.
Mhm.
But they owned like this big piece of land right downtown, and like I think the land sold for like $50 million. Like it was incredible. But like the diner is no longer there.
Yeah, the diner was making like $550,000
Yeah,
and 200 grand was in cash, and like, yeah.
exactly. Yeah,
Uh,
yeah,
but I think going back to what you were saying is like, and this is where we at Arcona and what the podcast have been, I've learned an immense amount over the handful of years doing this, that like what you just said really differentiates the tradespeople and their craft of owning a company, which by the way, like we were copiers, like we knew the copier in the IT space really well. 115 employees. I mean, that's a decent sized like middle market company, but that's all we knew. We didn't know how to deploy capital to make it continue to grow. That's why we gave it to the commercial real estate or a wealth manager. But what you're doing is you're seeing, like, if we wanted to deploy $2 million, what is the spectrum that we can deploy that in? Like, how do you guys go through that process? Like, how do you divide and conquer those duties of running the companies, looking where to deploy it? And
yeah. So a lot of this falls right now onto my husband James. So really, like usually we think of it in a couple different tiers. So usually like the highest return will usually be in the company itself. So whatever construction company wants to buy a new skid steer to replace an old one, it's going to cost some money, but it's going to allow you to be more efficient and less downtime, or maybe have an extra crew out or whatever. And so those are always the top priority. And all of our people will know if like they're going to invest in capex or any of that sort of stuff, like we are going to be asking about like the return associated with that investment.
can
And
clarifying question on Trish is
yeah,
like, so do you, in each of your, like of the 9 companies right now, nine different segments or industries, I don't know what they're spreaded. Do you like look at, like, how do you reverse back into this? Is it like market opportunity, and then like where are we at and what kind of growth rate can we expect? And what's it going to take to fund that? Or like, how,
honestly, it's a little more casual and informal than that. It's going to be a little bit more like each CEO is really making their own decisions, but
okay.
like they know that they're going to be talking to us about those decisions, and that like when they're talking about it, they're going to be like this is how I'm thinking about the return. And honestly, a lot of that is much more back of the envelope than like some formal big like
Like
presentation. And
their gut like instinct of like, where could this
yeah,
be, and what do we need? Do we need a tool and die machine, or like
right.
15 more lawnmowers and a skid loader or
And then
something like
like
that?
how much is that going to cost? Can you
Yeah.
finance it? How quickly are you going to pay it back? Like those, it's going to be it's more of like a conversation, not
Okay.
like this big thing. And then then there's the opportunity for potential tuck-ins for an existing business. Those can usually be very attractive because they're usually small local people that want to sell to you. Usually you can get them for a good price and you can kind of like absorb them into your business. So an example would be lawn care company. Some guy in the next zip code over has like 3 techs, a couple of trucks, and wants to retire. Like
Yep.
something small like
Doing
that.
probably
You're
like
just
500 grand, 600 grand in revenue or something like that. Yeah.
yeah, exactly. And like you're just basically buying their accounts and hiring their employees, and
Yep.
that's it. And so would probably be the second sort of source or like use of capital. And then the third would be like a whole new acquisition that's like a separate thing. And when we're kind of doing our like financy thing of underwriting the deals, we're looking for deals that have like a 25% free cash flow yield. So basically, like at the end of the day, after you've paid everybody who needs to be paid, are you generating at least 25% on the cash you put into the business? And so that's our threshold for like making a new investment.
That's awesome. So I want to, the listeners should bear with us here for a second because I want you I've been doing a lot of these presentations on the financials. So I've been doing a bunch of Vistage and EO presentations and talking about how to tie the 3 financial statements together, which is what that assessment that I shamelessly plugged in earlier is like. But when you look at the 3 financial statements, where are you finding this? And feel free to like go into the specifics. Like, how do you get to what is the free cash flow, the 25%?
Yeah. So in our deal models, we're basically saying, okay, revenue, our expected expenses, any debt payments, interest and debt payments and those structures, taxes, which is a little bit squishy, but just some sort of estimate, and then estimated capital expenditures on an annual basis. So that number is
X.
And then X, right? And then we look at that over, our models are 10 years long. So we look at that over 10 years. Then we go back and we look at, okay, so let's say you're making, let's make something up. You'll make $1 million a year of cash flow. So like at the end of the day,
do you actually, are you looking at like cash flow provided by operating activities in the cash flow statement? Or are you actually going down to cash at the end of the month?
So this is our deal model. So we're kind of like taking the cash flow statement and kind of like manipulating it for our like deal purposes.
Super important. So like, that is like you're taking what you need from it and what you're bringing to the table. And the listener should definitely soak that in because every buyer is going to bring something different to it. So like if they had you and 2 other people that was bidding on their company, that's how and other people are going to be doing the same thing.
Yes. And some people are going to be looking more at EBITDA, whereas we're looking at cash flow because that's what we care about. Because if if you make $1 million of EBITDA, but you have to spend $500,000 in CapEx every year, that's not on the income statement. Then like you only have $500,000 of cash flow, which is different, And so,
that's why I brought up that cash flow provided by operating activities. I mean, like that's really, and that's only found in the cash flow statement. And the reason I'm bringing this up, Trish, and I'm not trying to drag us down a rabbit hole here, is that I've just been unbelievably shocked. I mean, like hundreds of people that I presented from lately, no one looks at the cash flow statement. I mean, when I say no one, it's like a handful. But like, that's for the bankers. That's for the bankers. That's for the accountants. I'm like, how are you running your damn business if you're not looking at it?
Yeah. Well, I think that would be pretty accurate of most people in finance too, actually, interestingly. Like a lot of people don't really look. I mean, I went to business school and like I feel like we were just kind of like, like I don't know, the accountants will look at that one. Like it wasn't really like something we looked at. But then like, you know what? Like once you operated a business for a little while, you start to realize like that statement's pretty important. Especially
especially if you're running out.
Yeah, especially if you're running out of cash, that becomes a very, very important statement. So
I it's so funny because it's like, wait a second, I had a positive net income. Why do I have no money? And like people just don't So I know I'm taking up quite a bit of time here. So when you're thinking about the future and like what you guys want to become and what you want this part of, I mean, you're kind of pioneering and part of the pioneers of this new market. What do you hope for everything?
Well, that's a tough question. Just in that we probably this ties back perfectly, like to the beginning of conversation. Like we haven't really been like big, this is where we're going to be like in 20 years kind of people. But I think that we see a very large market opportunity. And I think that if we can get it right in terms of finding the right people to run these businesses after transition, because that's really what it's all about, is finding the right people, kind of matchmaking them with the right business, and having a track record that owners feel comfortable working with us to sell their businesses to us because they trust us. I don't think there's really any kind of ceiling on our growth. And so we're investing a lot right now in sort of the systems and processes and people that we need to manage, much more. So we talk about, 50 companies, 100 companies. Like, what are the things we need to be doing now, and the processes and the culture and the values and all that stuff that we need to have to manage a much larger portfolio. And so that's something we're always thinking about, setting ourselves up to take like that next step of growth. And it's cool to think about how we could do this at with more scale. And that's
what are your biggest constraints?
Our biggest constraints, well, there are going to be two. So our biggest constraint is because we don't have external investors. The cash flows from our business go to fund the checks. So if our companies don't do well, then we can't buy more companies. And frankly, if we had more money, we could buy more businesses because we see so much opportunity out there. But our growth is a little bit held back by our ability and how quickly our companies can generate cash. And so I actually don't mind that sort of limiter on our growth, because I think it allows us to make sure that we're ready for the growth when it comes.
And discipline, right? I mean,
Exactly. Yeah. We have discipline, and we're also, we can't grow too quickly to have things kind of fall apart from a process standpoint. So I don't really mind that one. So the next one is just, talented people to run the businesses, people who say like, hey, I want to be the CEO of a small business and I want that role and have that impact. And that's been a big focus of ours for the last couple of years. And, thankfully we've had some really, really awesome people come and join us, and they're adding just so much value to our company. I'm just so thankful for that, just hoping to kind of keep that pipeline going, so that, if we don't have good CEOs to place in our companies, we're not going to buy them. It's just not going to happen. And we make sure we tell that to the sellers, up front, that if I don't have somebody to run this, I'm not going to do it. So that's the biggest limiter. We're constantly working on making sure that, that's not a problem, but it's something that is a constant focus of ours.
I wouldn't be shocked, Trish, if we circle back in 10 years and those two constraints were one of the bigger components to your guys' success, because I watch when there's huge piles of cash, people then have to deploy it, and then they made terrible decisions on hiring. They made terrible buying decisions on the business. And like, I wouldn't be surprised if it's just facilitating the discipline to keep the snowball going. I mean, we all know the biggest snowball out there is Buffett and what he did. So it's apparently worked, right?
It's so funny to me. I gotta go.
Go ahead. No. Yeah, go.
At bedtime, but it is funny to me how there are so many people who are such like disciples of Warren Buffett, and like, they love him and are, go to all the annual meetings and read all the books and all this stuff. And then they like don't actually do any of the things that he does. Like, it's like what he did, even if you want to replicate it at a super small scale, is not a secret. It's pretty straightforward. And he's been very transparent about it. But like, nobody seems to actually like do that, which is like very confusing to me. But like, it's just, I don't know if you have any answers on that.
Well, I like my one comment, and then that's a whole conversation, is I like, he was doing this back in the day when he could look at the financials in an analog world. There wasn't, high frequency trading that had market, pricing immediately. I swear to God, what you're doing, Trish, is as close to the new modern version of what he's doing. And the reason that, I mean, he wasn't running the companies like you were. like you are, right? Like, so I mean, there's
No, but
way
I
more
think that if the way I like have read it is that in the early days he was much, much more
active.
involved
Yeah, no,
than
you're
it
right.
might seem like he was,
There's a
especially
fan.
now.
Yeah, I would agree. There's a fantastic book that I read called Snowball that was on him. It
Yeah.
was my favorite book on him. But anyways, so we'll get you off and running. So two final questions. One is I want to know what the word intentional means to you because the name of the show, and I think it has a unique meaning when you combine it with growth. So what does the word intentional mean to you?
I think we talk about being successful on purpose instead of by accident. And so I think like intentional is kind of, it means the same thing. It's being, not kind of letting things happen to you, but making, using all the information you can, as well as just your good common sense and judgment to make decisions to get you kind of to wherever you want to go.
Love it. That was awesome. Best place to find you, get in contact with you, learn more.
Yeah, so my email is trish@chenmark.com. Also, our website, chenmark.com, has an info email that is actively monitored. We are not active on Twitter, so probably best not to reach out to us there. But really, website's the best way.
Trish, thank you so much for spending the time. I had a blast.
Thank you. Appreciate it.
Good luck at your competition.
Thank you.